Now it is my turn, being a member of the co-legislator European Parliament, to present some insights from this perspective. In view of the time constraint, I would like to point out already at this point that I will restrict the focus of my speech to the broad and general picture, which will be supported by several concrete examples. I will be happy to continue the discussion on further measures with you more in detail during the subsequent panel debate. At first, let me take a short look at the previous legislative term. The Committee on Economic and Monetary Affairs alone, which is in charge of the regulation of financial markets as well as for the deepening of the Economic and Monetary Union, has passed more than 60 pieces of legislation under the ordinary legislative procedure, the co-decision procedure. If you go further and count the opinions and the resolutions as well, the aggregate number well exceeds 200. Without a doubt, two decisive milestones of our work. On the one hand, the establishment of the European System of Financial Supervision, consisting of the European Systemic Risk Board and the three European supervisory authorities, EBA, ESMA and EIOPA. And on the other hand, the giant and challenging project of the European Banking Union. In this manner, policymakers have not only regained control over financial markets to a large degree, but also have strengthened and prepared the financial markets for future crises and thus restoring confidence. If one would have to illustrate the ongoing measures in the past years in one single image, one could easily say that in the course of the financial and economic crisis, we were forced to repair a car while it was still driving, and also traveling at very high speed. Instead of opting for a uniform large legal proposal, we have pursued a piece-by-piece approach to regulate and fix each field by separate measures. As a direct result, the car is still running, and we can proudly say that it runs better than before the crisis. However, we have to admit that it's not yet fully on track. This leaves us, therefore, with many things to do, and in the current period, we must pursue two directions. Firstly, priority must be given to areas which have not been fully regulated and where regulation is urgently required. In this context, let me just name the currently ongoing bank structural reform and the need for appropriate regulation of the shadow banking sector. If we really want to live up to our aspirations to make financial markets resilient to crisis in the long term, we must not lose any time, particularly in these domains. Financial markets are extremely fast-moving and subject to change, so that we cannot allow ourselves to look for solutions and answers once the crisis is already here, but we are instead obliged to prevent crisis by establishing appropriate regulation and supervision in the first place. Secondly, due to the fact that we were forced to repair the car while driving, it is equally important to lay the focus on critically evaluating the implemented legislation and measures and to thoroughly assess them regarding their proportionality. I have to be frank here. Neither does this entail the abolition of or watering down of regulation, nor shifting down a gear when it comes to closing regulatory gaps. Instead, the evaluation has to follow the principle that regulation and economic growth are not mutually inclusive but complementary. Whereas a certain degree of regulation creates confidence and stability and consequently supports economic activity, we must not overstep the point when additional compliance costs of regulation exceed the additional value. Ideally, this tipping point can be identified. So we are talking about fine-tuning the existing legislation here. Fine-tuning is precisely the focus in the report of the Committee on Economic and Monetary Affairs written by my colleague Burkhard Balz. In fact, the title speaks for itself. Stock-taking and challenges of the EU Financial Services Regulation impact and the way forward towards a more efficient and effective EU framework for financial regulation and the capital markets union. Long title, much work. In the European Parliament, we consider it of utmost importance for the current mandate to critically assess and evaluate the rightfully enacted legislation for the financial sector regarding their proportionality. On this occasion, let me give you a concrete example. Anna-Kredit. It goes without saying that the ECB's supervisory tasks are important and that in order to fulfill their mandate, they should have precise insights into the credit business of the supervised financial institutes in order to detect risks and adjust monetary policy accordingly. However, the additional benefit of such collected information has to be proportionate to the additional organizational and financial efforts these reporting obligations impose on especially small and medium credit institutions. It is hardly acceptable that the European Central Bank demands information which exceeds the current reporting obligations by roughly 15 times. The most strange things are out of the scope of this data in the meantime. At the very beginning, they asked for loans higher than 25,000 euros for which religion is the one who asks for a loan. Is he married or divorced or whatever? So strange things like this are outside. Other things we have to have a closer look on are still in the scope of the European Central Bank. This can threaten particularly the existence of small and medium-sized banks. In this way, precisely those banks which during the crisis have shown a good track record in most of the EU member states will be punished and have damages inflicted upon their solid business models. Driven by the same principle of proportionality during the determination of the contributions to the Single Resolution Fund, the European Parliament has negotiated hard to not lump all banks together. Rather, the approach who risks more pays more, as well as the size and systemic relevance of each particular institute were taken into account as well. Not as much as the European Parliament wanted it to be taken into account, but at least somehow. The stock-taking, however, does not apply to already existing measures. In fact, this approach should be also constitute the basis of upcoming legislations, such as the plan to establish a capital markets union or to further deepen the economic and monetary union as envisaged by the Five Presidents' report. If we return to our picture of the driving car, instead of doing the same mistakes all over again and evaluating the effects ex post and at full speed, we should this time seize the opportunity to perform the universal check ex ante and guide the car safely by establishing good infrastructure and strong guarding rails along the sides. For these reasons, we demand from the European Commission, when initiating new legislation, as well as from the European supervisory agencies when publishing technical standards and other level 2 measures, not to restrict the scope of the impact assessments to the field or financial product which needs to be regulated. Instead, the impact assessment should from the beginning take into account the overall big picture and evaluate the impact of the respective measure in the context of the existing legislation. Here, the Capital Markets Union, whose rough outlines have been presented by the European Commission yesterday, provides another example. The creation of Capital Market Union should facilitate the access to capital markets, particularly for small and medium enterprises, create a category for safe and sustainable securitizations, and encourage particularly long-term financing. Overall, this approach to create new sources of financing for small and medium enterprises is to be welcomed, because we waste huge potential in many member states of the European Union if enterprises with innovative ideas are not able to find investors. However, the opportunity must not be overweighted by the risks. We will therefore take a very careful look on the concrete implementation of so-called simple, transparent and standardized securitizations. These assets are only acceptable if it can be guaranteed that in each individual case they are considerably safer than other securitizations. And this quality label is only beneficial if one can be certain that in every single case the content corresponds to the label. It is out of question that we reopen Pandora's box of intransparent, highly complex and therefore extremely dangerous toxic papers, which we had to close after the US subprime mortgage crisis caused massive spillover effects in Europe. Moreover, it must be ensured that financing via the capital markets can only be a complement and not a substitute for established banks' lending services, as they are offered, for example, by saving banks, cooperative banks, or public promotional banks. My arguments indicate clearly, as is often the case with plans, what really matters is their concrete implementation. It would be wrong to consider the Capital Market Union as the universal remedy to boost investment in Europe. It is equally important that the regulatory framework for small, medium enterprises must be improved, for example, by cutting down on red tape. In the same manner, legislators must already at this point take into account the impact a potential introduction of a financial transaction tax could exert on costs and additional benefits of a capital markets union. Therefore, what we need is a holistic approach. Only then it is ensured that one gear wheel sizes perfect into the other. Otherwise, we run the risk not only to overburden market participants with unnecessary red tape, but also in the worst case to create new loopholes which have to be closed ex post under big additional efforts. For this holistic approach, a continuous exchange of all stakeholders, both from politics and from the side of the financial market, is required. For this purpose, conferences such as the one today provide the ideal platform. Therefore, now I'm looking forward for an interesting and lively discussion with you. Thank you.